Hello, everyone. My name is John Richards, founder and CEO of Startup Ignition. Appreciate very much you being here today for this webinar called Financing Your Venture. Purpose of this webinar is to share a little bit about Startup Ignition, help you become familiar with it, and let you know about our upcoming cohort, which we have a few seats left that starts next week at the Kiln co-working space in Lehigh. So we'll get started today. And first of all, the Startup Ignition experience that's happening at Kiln this next week will be September 18th, 19th, 20th, kicking off a 3-month experience with Startup Ignition, 3 days of intensive, dense material taught in a digestible format. And we'll tell you more about that in just a minute. The agenda for today is I'm going to tell you a little bit about Q&A instructions. If you have any questions, feel free to write them in the group chat window, and we'll cover those at the end when we have a few minutes left for Q&A. So please go ahead and do that. Also, I'm going to get a little street cred, just sharing with you my background. Many of you are probably familiar with it, but I'll go through it real quickly for those that are new. Also, tell you a little bit about Startup Ignition. We'll cover that real quickly as well, and then eventually get to our topic. And that's the wrong topic. I didn't change that today. It's financing your venture, not is your business idea as good as you think it is. My bad for not changing that. Apologize. With that, a little bit of street cred. I'm an entrepreneur, investor, educator, and mentor. As an entrepreneur, I've started many companies, have had 2 multi-million-dollar exits, one actually quite successful with an IPO in 1998 during the dot-com era. And I've kept myself sharp by becoming an angel investor. And for the last 20, 25 years, I've done about 85 direct investments, hundreds of others as limited partner in seed and venture funds. And there's some logos there under investor of some of my successful local companies in the Utah market that I've invested in over the years. Also, I'm an educator. I spent 12 years at Brigham Young University. It was unranked when I got there. When I left, it was number 2 ranked. I've taught hundreds and hundreds of lectures and classes, and have helped out locally also here in Utah at Utah Valley University, and of course with the Startup Ignition Bootcamp. As a mentor, I've mentored not just hundreds but thousands of entrepreneurs in the field of entrepreneurship. I was a founder of Boom Startup, also a program called Utah Student 25, and also was over a decade with Utah Angels, and for a number of those years was the managing partner of Utah Angels. So I share this background just so you know there's a been there, done it component to Startup Ignition. This is representative of some current angel investments I have, of the 25 current ones I have going. These are some of those that I have great hopes for and that they'll have great exits and outcome. With that, Startup Ignition, about that, Startup Ignition is a intensive entrepreneurship boot camp, and it's modeled after the new format for boot camps in the dev software coding world and digital marketing world, where you've seen boot camps where you have 12-week experiences that outperform 4-year degrees. We're doing the same thing in entrepreneurship, where you engage for 3 days of intensive in-class experience and then get mentored for 3 months unlimited basis to put into action what you learn in the boot camp. So with that, we're looking for 3 target audiences. One are those who want to start a company, have an idea percolating in their head, and they want to find out if their idea is worthy and if it should go forward and how to go forward. Also, those that have already started a company are currently in the startup throes, and those are folks who really benefit from the boot camp. We also have helped a number of companies that have started maybe in the past year or so, and things just aren't going as well as they'd like, and we can get them on the right track. A byproduct of Startup Ignition, interestingly unintended, is that many people that have taken it that find out that entrepreneurship is not for them, which is about 10% of the people that take the boot camp find out that entrepreneurship is not for them. They go back and get better jobs with better equity offerings and just know how to talk the language of business better, and it really benefits them. Now, the Startup Ignition model is all about doing the right things in the right order. The big problem in entrepreneurship and why so many fail is that they're doing the right things just out of sequence. This is called premature scaling, and accounts for about 3/4 of all the failure in entrepreneurship, just doing good things, the right things, just out of sequence. So when we look at the evolution of a business from the discovery, validation, efficiency, scale, sustain, and renewal phases, what we're doing in Startup Ignition is we're helping you do the early stages right. And we really focus on customer discovery and business model validation very, very strongly so that you're prepared to do a good job in the efficiency stage before you start the scaling phase. The problem in today's entrepreneurship, and the problem it has been for decades, and why there's such a high failure rate, is because entrepreneurs often start at the scaling phase, which is what you would do if you were in a large company putting out a new product. But that's not what startups are. They need to go through these first three phases: discovery, validation, and efficiency, in order to make it. We have a model here of what we take you through in some of our curriculum. I won't go over this detailed slide here too much, but the crowning principle here is that we're looking for you to finish the experience with a validated business model. Having a validated business model, you can prove to an expert that your hypothesis for how you're going to create, capture, and deliver value in the marketplace will work is a big thing, and we do everything we can to get you there. The instructors and affiliates of the program, myself and Gary Rhodes are the two main instructors. We're two of the top instructors at Brigham Young University over all the years, highly rated, and have honed our skills and curriculum over the years. Also, Tyler Richards participates, having learned from me all his life and going out and making it happen. He had a $20 million exit just a few years ago, and we put him a little bit on the stage to share his experience. Also, one of our alumni, recently I've elevated to affiliate status. He may even be on the call here. His name is Eric Espinoza, and he's become a master at some of these processes of validating your venture, conducting wow factor tests, and we've had some previous webinars recently on that. The Express course that we're trying to market here with this webinar is coming up in Lehigh next week, September 18th, 19th, and 20th. These will be the 3 first days of the cohort, and we'd invite you to apply at startupignition.com. Applying is no obligation. You just get a 15-minute interview with me, and I give you some feedback on what you're thinking and doing in the field of entrepreneurship, and you take a test, and then we see if it's a good fit for you. We have a great cohort coming up with a lot of great participants already set, and we'll just kick it into gear 8 a.m. this coming Wednesday. We're going to hold it at the Kiln co-working space, a state-of-the-art entrepreneurial workspace that's in Lehigh, and also they have a Salt Lake location, and we've partnered with them to be our host facility. Kiln, at the Kiln space when we start, the tuition for the 3-month program is $1,999. Many people feel that it's worth much more than that. We try to make it as small as possible, but still have meaningful value to it. We have discounts for multiple founders. If you have more than one from a startup that wants to take this, we're very generous to do a 2-for-1. And also women entrepreneurs get a healthy discount to $1,500 with the $499 discount. So looking forward to seeing some of you apply. To sum up Startup Ignition, it's not how pretty your car looks on the outside or how much you feel like you're looking like an entrepreneur and acting like an entrepreneur. We really get in and look under the hood at how your engine is working and whether you've really put the pieces together right, and make sure that the nuts and bolts, the pipes and the tubes and everything is getting maximum output and we'll get you to the finish line. With that, the value that we offer is knowledge, mentorship, networking, and peer-to-peer interactions that really help advance your cause in your startup venture. Again, Startup Ignition, the good news is entrepreneurship can be taught. It's an entrepreneurship bootcamp, short-term intensive skill training format that really pays high dividends. With that, we're kind of done with the introduction of myself and Startup Ignition. Hope to see you apply at startupignition.com. Let's get into today's topic of financing your venture. Most entrepreneurs, when they want to meet and talk with me, they want to talk about this topic. How do I get money? How do I finance my venture? So we're going to go over just some principles today to give you a little flavor. We spend a lot of time on this in Startup Ignition, and this is just a brief few moments together to talk about some important principles. With that, excuse me, the first thing I like to bring up here is it's very important for the entrepreneur to understand where their venture is on the startup positioning map. If you look at this quadrant graph, in the upper right, we have lower risk, solid return businesses. These are businesses that usually are going for profit, and they have a distinctive confidence in the founding personnel or key first hires. They are filling a need in their customers' business or life. So examples of this would be at the ultimate top right corner would be like a consulting company, a lawyer, a law firm, an accounting firm. They have a distinctive competence that even has to be certified by the government, and only they can perform, and they charge for the hour. These kind of companies usually swap hourly human hours for money. Unfortunately, that's not very scalable because humans only get a certain amount of hours. You can't scale that. And these kind of companies are lower risk, solid return. Unfortunately, in the venture world, these are very unenticing. They don't offer high multiples of returns to investors. And often they don't need investors because they're just selling time. On the total opposite end of the spectrum, in the lower left, are the very high risk, very high return businesses where they are at the total extreme trying to change the world with new products or services that disrupt. And so they're usually characterized by a revolutionary disruption and going for high user growth. So at the extreme lower left, we would have companies like Facebook, Instagram, and others that create massive value by getting massive user growth and disrupting processes and the way that the world does things. These companies are very sought after by venture investors, and they receive lots of capital because they have the chance to deliver the kind of returns that investors are looking for. A little tip, the venture investor, as a rule of thumb, is looking for a 35% internal rate of return, IRR. That's a 35% annualized return, usually over a 3 to 7 year period. That means they should be getting somewhere around a 10x on their money. If they give you $100,000, they want $1 million back in a reasonable time frame, and that will give them that kind of return. Now, this is how I try to explain to all of the frustrated entrepreneurs out there how and why investors behave the way they do. So I made a slide to explain it. So let me do my best job of explaining it here. First of all, it's about understanding how venture investors accept risk and write checks into risky ventures. All startup, emerging, and early stage companies are very risky as an investment class. So why would they write a check into it? Well, they have to find a way to mitigate that risk in their brain so that they're comfortable writing a check. How do they do that? Well, first of all, let's take a look at the different stages again of a company. If we're here at the idea stage, the validation stage is where we would be doing tests like wow factor tests, interviews, rapid assumption tests, looking at what our minimum available product would be, and we talk about all of this in Startup Ignition. And then we would finally nail a business model through those efforts. And a nailed business model means that we've got a business model, we've found product market fit, and we have our first customers or users that are coming in. Well, then we look at the build phase. Well, the build phase is where we set up efficient infrastructure for sales, onboarding, customer service, and retention. Then the next step is the scale phase, where growth and expansion is happening, and we're pressing on the accelerator. Well, when you look at what's going on here at the early stages here in the idea validation, nail stage, we have very, very high risk. And there's a lot of perceived high risk, and it's a real perception. The revenue and traction that the company can show is usually very minimal. And so that does not help in overcoming this risk profile. So it's hard for a lot of investors to make those investments early on. I find a lot of entrepreneurs out there thinking, hey, if I come up with an idea, my 2 or 3 co-founders and we do some work for a few months, we can just close a great funding round and be on our way. Sure, we haven't built a product, we don't have any revenue, but somebody's got to fund us so that I can get some kind of money so I can survive. Unfortunately, that's not how it generally works. If you really look at every deal that's successful, I can show you that's not how it generally works. So let's take a little more look at this. The investment size that you'll get kind of lags behind your revenue and traction. So people get more comfortable as you experience revenue and other forms of traction so that they will part with their money and invest in your venture. This has an important ramification. So let's take a look here again at this early stage. Who is going to invest at this early stage? Well, this is the friends and family region. Why would they invest? Because they have personal trust in you as a person. You're the founder of your company, and because of your personal relationship, your prior relationship, and they think you can pull it off, they're going to write checks and help fund you. That's where most people get their funding at these early stages. It's very hard to talk financially motivated, arm's length investors who don't know you into investing at that early stage. Also, it's a reality that most investors that get involved in venture tend to migrate to the left where they feel comfortable investing, which also is fighting against the average entrepreneur. The next phase, when we're into the kind of mid-range here, who's going to invest once we've nailed the business model, but we're still kind of working on building our infrastructure and figuring things out? Well, that's where we have to look for angel investors, individuals that have some kind of domain expertise. If they're an expert in B2B SaaS companies in the electronic space or in the any kind of space, whatever, they're going to be more inclined to invest at this way. They can dig their teeth into it. They can sink their teeth into it, dig deep, roll up their sleeves, be an advisor to you, put in some money. There's grants available at this from the federal government and other entities that will give grant money because they've seen that you've nailed a business model and you need some help to get through this stage. Corporate venture arms and family offices are also possibilities here because of their thematic and vertical interests, and they'll come in at this more likely than an institutional seed or venture fund. They actually come in the next phase where we're looking where you have some kind of sustained traction. That's where you attract institutional investors like the local seed funds here in Utah or the larger full venture firms that are here or out in Silicon Valley, Seattle, New York, Chicago, Boston. They want to see sustained traction. That's how they feel comfortable enough to write a check and take the risk of investing. With this understood, we can be smarter as entrepreneurs in how we approach fundraising. Let me go on and share a little bit more. What do investors want in a startup? Well, above everything, they want traction. Traction matters above everything. You have good traction, and you're going to get investors that are interested. So to learn more about traction, I recommend this book by Gabriel Weinberg called How Any Startup Can Achieve Explosive Customer Growth. It's called Traction is the name of the book. You can go to the website and get the first 3 chapters for free if you're interested, but it's one of the most important books in the field of entrepreneurship in the last 5 years. There's different kinds of traction. We can do innovation accounting because there's financial accounting where we can track, revenue and sales and expenses and look at how we're doing. But we can also have use an accounting that measures progress and holds entrepreneurs accountable by looking at their innovation accounting. What does this mean? Well, here's an example. Dave McClure, famous angel investor, he has what he calls his pirate metrics, and he just asks you 5 questions. How do users find you? Do users have a great first experience? Do users come back? How do you make money? And do users tell others? So he's looking at acquisition issues, activation, retention, revenue, and referral. So when we're looking at this, if we don't have revenue yet, we can demonstrate some traction by showing that we've got some customers interested or just signing up. We've got competitors and looking at what they've achieved and done and how we can beat them and have an advantage, a sustainable advantage. We can look at the team we've been able to put together. If you've put together a great team, that's great. An advisory board with advisors that are hanging around you and helping you. Investors that have put in money in some way. If they have some relevant noteworthiness, that's a sign of traction. Now, back to financial traction. What is a good month-over-month growth rate for a SaaS company is a good question a lot of people might have. This month-over-month revenue number or customer growth number or user growth number, this is a very important metric in the institutional venture world. So I've got a lot of data I could show you, but the bottom line is this. If you can work towards 10% month-over-month growth in revenue, customer count, or user count, and sustain that for 4 to 6 months, you will be in control of the fundraising process. Here's an example. This is an investment I made. I made an investment in this company, and the CEO sent me this email. This is the entire contents of the email in April of 2017 when he gave me an update. He said, in December 2016, we had 28,000 revenue. That was 39% higher than November of 2016. Then each month went up 50%, 57%, 27%, greatly exceeding the 10% per month over month growth that we like to see. And then he gave one general update, said growth. We finished March with 84K in MRR, monthly recurring revenue, up 27% from February. And we're spending about 36K on salaries right now. Well, this right here, the succinct email makes the hair on the back of my neck as an angel investor stand up, because this is incredible. First of all, look at the sustained month-over-month growth. Look at the MRR he's up to, 84K. That's getting very $1,000 away from a run rate of 1 million annual recurring revenue. And those are numbers that get everyone excited. So this is kind of the nirvana, the target to shoot for as an entrepreneur if you want to get true institutional money from a seed or venture fund. With that, bottom line, no traction generally equals no money. So we've got to show traction in some form or fashion to get arm's length, sophisticated investors to put money in. Now, there's some presumptions that persist, that you need extra capital, that you are ready to seek for capital, that you've nailed your business model, that your deal is clean, that you don't have a messed up cap table, that you have clean founders, founding team is complete, full-time and all in. Those assumptions right here are what true institutional venture investors are assuming you have in place when you come talk to them. If you come talk to them and you have a messed up cap table, unclear ownership, people are not sure if they're going to be full-time at the business, these are real red flags to them. Now, in looking at this, some traction of a B2B SaaS example, I went and asked several venture funds, okay, which B2B SaaS metrics are the most important to you and your firm, and what ranges in those metrics excite you towards an investment? Well, here are a couple answers I got from local Utah venture firms. Venture investor number one said the most important thing is lifetime value over customer acquisition costs. So they're looking at that ratio and they want to see it, 3, 4, 5. If it gets to 6 or 7, they're super excited. They're also looking at your churn numbers and the retention. They don't want to have high growth with bad retention. They're also looking at, that should be MRR, not MMR, sorry about that, trajectory as a percentage of ARR. So they're looking at, the acceleration rate. They're looking at your full run rate based on trailing 3 month. Pipeline growth, they want to see what your pipeline looks like and your sales cycle. You can see that you have to be pretty far along to get the interest of these type of investors. You can't just be at the idea stage or have barely just started working on validating your business model or just recently found your product market fit in the business model. Another one said, our most important thing is MRR over ARR, and they want to see that the MRR is about 15,000. Most people they want to see it in the 15 to 50K amount level and at a 10% month over month. So monthly growth rate percentage, most tell me 10%. This one said 15%. CAC over LTV, they said very hard to trust at the early stage, but good to get her feel directionally. Very dependent on customer base. These are real comments, exactly copied from emails I got back from the firms. They also like to see the ARPA, the average revenue per account. They want to see, they don't like if it's too small. Again, this one's looking at churn. So you can see they all have a little bit of different take on what's important to them, but this is important to understand that they're looking at these type of things and your gross margin. Here is Peak Ventures, a prominent seed fund here in the state of Utah. They have what they call their 5 T's. And when you meet with them the first time, they have somebody in the room writing notes and writing things down and making either a green or red check mark on these 5 areas. And they're looking at team, terms, traction, 10X, and technology. That's how strong is your team, what kind of terms on the investment, what kind of traction have you achieved, is your solution 10 times better, or how many times better is it than existing solutions, and do you have any protectable technology, intellectual property? So they're looking at those elements. Team, terms, traction, 10X, and technology. Lastly, in today's presentation, I'd like to just share with you that you need to tell your story well. Just a few days ago, I held an in-person info session that covered this much more detail. But you need to be a good storyteller. We talked about how you prep an executive summary and how you make an oral presentation but that's for another webinar. Again, that's my presentation for today. You're invited to apply to be in Startup Ignition this coming week.